northmantrader.com oder bei Twitter seinen legendären Feed. And I have to tell you, Sven, that there are very few people on Wall Street that make me laugh as hard as you do. You have a certain level of sarcasm when it comes to the stock market. Where do you take that from?
Well, you know, it kind of writes itself. You know, I'm just commenting on the absurdity of the world that we currently live in. You know, that George Carlin, a famous U.S. comedian, once said, "If you scratch a cynic, you find a disillusioned idealist," and that's kind of the camp I'm in, where I'm saying, well, you know, maybe this is the way the world should be, but obviously it's not. And so you see what's going on in the world on a macro basis, and you kind of have to scratch your head and say, well, it's quite amazing what's going on.
It has been a very strange world, especially caused, of course, by the by the COVID crisis. And I think many have a problem basically gluing it all together, looking at the booming stock market and at the same time the tanking consumer confidence. Ich würde vorschlagen, dass wir das Ganze in 3 Segmente aufteilen. Dass wir am Anfang das Thema Makroökonomie machen, dann machen wir ein bisschen Notenbank, dann die technische Perspektive und dann beantworten wir auch eure Fragen dadurch immer wieder. I would suggest then that let's dive into markets first. So ironically today, Tobias Levkovich of Citigroup, who has been more on the bearish camp the last couple of months, is finally giving in to this rally. And I think a lot of professional institutional investors are being forced into the market by the Federal Reserve. He's basically saying that it makes no more sense to basically fight the Fed. The blistering Fed policy and the negative real rates are basically forcing this market higher. What's your take on that?
Well, I think that's kind of good news for bears, right? I mean, you want bears to capitulate, and you want everybody squeezed out. That's kind of what you see at any major bubble or top. Now, his point is obviously on point in the sense that the Fed is completely controlling the liquidity equation and therefore asset prices. What my view in general has been is that, you know, over the last few years, we've seen a complete failure of the global monetary system. Remember, following the great financial crisis, the promise was always that central banks would extract themselves, right? That the intervention were going to be temporary and QE would be rolled back and interest rates would be raised, and we go back to a economy running on its own and markets running on its own. It's morphed into something called permanent intervention. The ability of central banks to basically let any wobble in the economy or in markets take place has been reduced to zero. The ECB has never even managed to raise rates to zero, being on negative for years under Draghi, and that during a 10-year expansion. I think that's pitiful and actually speaks to the structural weakness underneath it all. The Fed, to its credit, and when Powell came on board, I was initially kind of encouraged. I said, well, maybe this guy actually is going to follow through, right? He tried to reduce the balance sheet. He tried to raise rates. And then as soon as markets wobbled, and by the way, he did that on the heels of the U.S. tax cuts, right? That kind of gave him cover. You know, we have all these buybacks. The tax cuts should bring some growth. Let's try extract ourselves from that a little bit, right? And then as soon as markets dropped 20% into the Q4 of 2018, he completely flip-flopped. And it's been on complete intervention mode ever since. And COVID, obviously, was not the first step. COVID was just the trigger to just go balls out in complete insanity mode. That's my structural issue. So we have seen over the last few years that there is no way that central banks can extract themselves. And now, of course, they've got more than tripled down here, really, with no end in sight.
But now let's take the perspective of a stock market investor, of retail investors or institutional investors. However this might be, if right or wrong, or what the Federal, or the long-term consequences of that, what the Federal Reserve is doing, Tobias Levkovich of Citigroup is also saying that by the end of the day, will there be a daily drop in the S&P of 500 points? And he's saying no, it will not happen because the Federal Reserve is basically or will prevent any sort of market setback. Doesn't that mean for investors, and you see this in my community as well, that, well, macroeconomic data, they don't matter. The only thing that matters is the Federal Reserve building up the balance sheet and fiscal policy stimulating, and with money being essentially free, real rates negative, you should buy stocks beyond belief, and basically valuation possibilities go through the roof.
Yeah, I mean, that's the great illusion that I think we all want to buy into. I mean, keep in mind, in January, February, the Fed was also in full control, right? They were running a repo from the middle of September, had greatly expanded their balance sheet, and suddenly crashed 35%. That seems to have been forgotten by everybody. And the issue is ultimately the great deviations that we see. One of the issues I've been tracking is obviously market cap to GDP. I know everybody's now on the point it's different this time and nothing matters. And I have to say, I mean, the expansion that we see in asset prices here in the last few months has been awe-inspiring. It was ironic because at the literally on the lows on March 23rd, I had an article out called the 1929 Redux. You know, we've been on the sell side in January and February. It wasn't easy. Then we had the crash, but then we looked to cover and we were getting bullish. And so the rally was coming. That was not a question. The question was, how aggressive was it going to be? And I said in the article, it's going to be awe-inspiring. Well, I'm now officially awe-inspired. I have to say that we got so high here on the indices is obviously shocking given the macroeconomic backdrop. But, and I have to make a really important distinction here, the indices are not the market. You know, we all like to conflate that. The reality is, if you look at equal weight, there's several equal weight measures out there. If you price every stock the same and see how they react equal relative to each other, equal weight, even as the S&P and NASDAQ are making new highs here, they're actually below the June highs. Okay, they're far below the February highs. They're far below the 2019, 2018 highs. There's been a continued divergence in this market. And of course, what's driving all this, as we know, are these 7-8 stocks in tech sector that have seen market cap expansions that we've never seen in human history before. I mean, obviously, Apple is on the big list there, as are some of the others. But you know, just look at Apple in the last week. It's added over $440 billion in market cap in a week. On what? On the stock split? I mean, you know, I see the retail mania that's out there, and people are chasing it. You know, I poked a little fun at Stool Presidente yesterday on Twitter, because he had a thing about, you know, you get more stock. You know, well, what I said was, you know, great.
I know.
You know,
I mean, this guy is insane. Yeah, but so.
Oh, yeah, he's playing to his audience. He's playing to his audience. I'm not being critical of him. I'm just pointing out that there is now a retail mania that's chasing these stocks. And by the way, may I add, in these previous few years, retail was always missing. It was kind of the classic 2000 bubble ingredient that was missing. And in a way, we have a perfect storm here that not only relates to the Fed. We have, first of all, keep in mind that the addressable stock universe is shrinking. You know, the Wilshire 5000 once had 5,000 stocks in it. Now it has about 3,700 or even less. Companies have been buying back their shares at extremely aggressive rates in the last couple of years, fueled by tax buyback, you know, low rates, obviously, taking on debt, the tax cuts that they got. So the amount of shares on the float that are actually out there to buy is significantly less than what it used to be. And this is really important to understand, like a stock with Apple. You know, you can look at, you know, this quarter they did great in the pandemic, but if you look at it over the last few years, there's hardly been any growth whatsoever on an earnings basis, but because they are reducing their float via buybacks, EPS growth looks like it's actually there.
Yeah.
And you know, and so you take that, and then you have this issue about retail investing, you know, brokerage fees coming down to zero, and then you have these people coming in with apps like Robinhood, and so yeah, you have this
But
entire.
Sven,
Go ahead.
I totally agree with you on all these points, but yet the market is going up. There is momentum there. Nobody quite knows when this momentum will end, and the risk of being too negative too early. If you were bullish a couple of weeks, bearish a couple of weeks or month ago, you would have pretty much missed the entire upside in the market. And God knows where this upside in the market has an end to it. And let me get to one question from the audience. I'm going to be going English-German a bit because a lot of my members are saying, wow, you know, I got to learn English now. Ja, also ihr müsst jetzt ein bisschen Englisch lernen. Ich werde da versuchen, ab und zu ein bisschen zu übersetzen. Ich gehe auch gleich jetzt schon mal auf eure Fragen ein. Wenn ihr also Fragen an Sven habt, bitte bei mir reinschreiben. Die laufen hier bei mir auf und dann baue ich das mit rein. So, a few members in my community are basically saying, look, I love Sven, he's a great guy. I love his charts. I love his take on macroeconomics. He's right. But he's always bearish. He's a perma-bear. What is your take on that?
Well, look, I get the comment, but I think it's, you know, it's part of the issue that you have, and that tops up processes, bottoms or events. You know, if I look at, first of all, let me just say, taking a contrary view publicly in front of a couple 100,000 people, you know, that's not an easy thing to do. You will get markets go against you, especially if you're critical of a machine that is intrinsically designed to go higher, right? I mean, markets go up 80% of the time. And then when I make bullish calls, they get forgotten, right? December 2018, I was balls out bullish. End of March, I was balls out bullish. But tops up processes, so then these things get stretched out. And you have to differentiate between a macro bearish view and a trading practical view. Now, I'm first to admit saying that August, for example, sucked, right? Because there's absolutely no volatility in these markets, and they just keep drifting higher on the index basis. But again, you gotta look beneath the details. You know, banks are down over 30% of the year. You know, Russell hasn't really done anything much either, and neither has the NYSE. Is still kind of poking around the June highs. So if you want to say about missing this and missing that, hey, by the way, it's okay once in a while to miss a move. I think the question is what everyone has to decide for themselves is what is risk reward that you are willing to engage in, you know? And, you know, everybody, NASDAQ 2000, everybody looked at genius chasing this thing up. The reality is that these things can turn incredibly fast. Now, I recognize we're in an environment where everybody bows down to the Fed and says, oh, by the way, you know, nothing bad can happen. And that's why, frankly, you know, it is incredibly easy to be bullish on Wall Street, right? Because what we've learned over the last 10 years is the Fed always does step in, so that if you're always bullish, you may be wrong for 3 or 4 weeks, and that's the end of it, right? Because the Fed steps in and makes it go away. I remember very clearly, and I'm sure your audience does as well, in January and February of this year, bulls were calling for all kinds of lofty price targets and earnings growth, right? And that was right in front of a 35% crash. In fact, I recall there's people that were out there, you know, the first 3-4 down days, they were saying buy the dip, you know, and then that was written down with 1,300 S&P points, and then they said buy, 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 buy. The Fed comes in, and now they look like they called the bottom. They didn't call the bottom; they were bailed out, and basically people got crashed in. And by the way, I'm just saying this from a reality point of view. There were calls for a bunch of earnings growth in 2019. There wasn't any. Okay, the only reason markets went up was because of repo by the Fed. There's no earnings growth this year on an aggregate basis. And frankly, I put out a chart this morning on Twitter. There's been earnings aggregate. Corporate profits have been basically the flat since 2012 in 8 years, while corporate debt has increased $4 trillion. Now, none of that has mattered at this point, but be clear, whatever we're looking at here going into next year, the world economy in the United States specifically, all growth is debt financed. We're going to be ending up with an economy that has 150% debt to GDP, $30 trillion in debt, corporate debt, what? $11, $12 trillion coming up as well. Now we can all pretend that this is a basis for a good structural growth economy. It's not. Which brings me to another key point, Marcus, and I just want to really highlight this. In past recessions, at least there was some shared pain, in the sense that equity prices also went down, and there were, you call obviously the financial crisis, you called it the 2000 bubble, and then this dragged on for 2 or 3 years until there was a real recovery building. Not this time. This time, I think it's created the biggest wealth gap expansion in our modern times. It was bad to start with, but what they've done here, in terms of the benefit towards the top 1% that own 87% of the stocks, let's be clear, right? The bottom 50% don't own any stocks, and they just lost their jobs, and their prospects are poor. I mean, I don't know what the long-term societal implications of this is, but I can't imagine it's particularly good.
Ja, also die Spanne zwischen Reich und Arm ist natürlich durch das, was die Notenbank macht, noch mehr auseinandergeschossen. Sven, before I get into all the questions, how are you personally navigating this market? You know, the market has been up tremendously. You have bad news, the market is up. You have no news, the market is up. I think your perspective on the macro picture and the technical picture is correct, yet the market is up. So how are you personally navigating this with your portfolio? And the next question would be, what would actually turn you more optimistic, more bullish?
Well, first of all, as I said earlier, August kind of sucked. There's been absolutely no volatility. I mean, I've called it the program. I put that out there. It's pretty amazing, actually. What we see is incredibly tight intraday ranges. We've had now 5 up gaps in August that don't get filled. We see these kind of tight movements. There's, basically, if you buy, whatever 10:30, 11 a.m. low is in the U.S., that seems to be working if you're day trading this. From a swing perspective, what's worked is small caps so far. They continue to drag, and so selling the peaks on that has worked. Selling S&P, selling Nasdaq has not worked. Basically, you're working, or at least we're trying to do, working with tight stop discipline. And then when you see a dip, you scale out, right? We call it a scaling process. And then you try to resell as you get flat stop. But you do take some stop losses. So I'm not pretending that this has been going well in August for us. But you know what? It didn't go well for us at the beginning of February either. That was exactly the same issue. You get, and then you see how quickly it turns, and then you're either in the move or you're not. The reality is the broader stock market is not doing very well. I mean, if you like the last 5 days. 4 of the last 5 days, all negative internals. There's just nothing really moving except a continued push into Apple, Microsoft, Google, Tesla, and the works. So, and that to me brings me to the larger issue. You can say, oh, the market keeps going up. Well, ultimately, the more extreme you get in a market, the more dangerous it becomes. March low was very extreme. Frankly, the February high was very extreme. And I'll make that as a general comment. Over the last couple of years, market moves have become ever more extreme to the upside as well as to the downside. And that speaks to a lot of instability in the system, which brings me to another point. August, we've hardly seen any movement in asset prices whatsoever. I mean, just these tight ranges, extreme low volume. And yet the VIX is still above 20. Now that may still get dropped into the February gap, 17.5, 18, if you will. But you have in February, when we were at lower prices, we were actually having a VIX around 11.5, 12, 13. So there's a divergence going on here as well.
There's a divergence going on yet. The last couple of days, we've seen the S&P equal weight index actually outperforming the S&P 500. We're seeing that market breadth, which has been increasingly negative on up days in the S&P. And just to explain this to the audience, it's very rare that you have a month of, in the S&P up 4% and half the month trading days were negative breadth. But you are seeing that breadth has gotten better the last few days. And many are making the argument that the stock market, that the price of copper that the inflation expectations are actually indicating that we are witnessing a reflation of the economy. And with the reflation of the economy, you will see a broadening of the rally. Maybe tech will sell off a bit, but all the other sectors that have not performed well will actually carry the market, even if technology corrects. What's your take on that?
Well, it's certainly possible, but at some point, someone has to tell the consumer that. I mean, you saw the figures yesterday. Consumer confidence is in the toilet. And that brings me to the entire issue of when you look at some of the big month-over-month spikes in data, how much of that was paid for with simply, rescues and bailouts. The consumer, and this is the big danger here, is everybody looks month over month. I think we need to look year over year, and to the extent that now you don't have more unemployment benefits coming through, these bounces may end up being fairly short-lived. And so the consumer is telling us something. I think the banks are telling us something. Why are the banks trading like dirt? I mean, you would think that if there was some sort of reflation argument to be had, then the banks should be trading. They're trading below the December 2018 lows, okay? And for month end, I've seen in recent months, they try to do that reflation trade with small caps and banks, and then invariably that gets sold again. So from my perspective, there needs to be some evidence that that actually takes place. And obviously last week, again, we saw claims go over 1 million new unemployed. So there's structural issues. And then, of course, layoffs becoming permanent, Marcus. And this is maybe just the great absurdity of all, right? We saw that with American Airlines. We're going to lay off 19,000 people now that we got our bailout. Thanks. Come on.
But let's go step by step, Sven. So the macroeconomic data of late have been disappointing. And if you look at this chart here, you have the Nasdaq ETF, the triple Q. And you have consumer confidence, and it couldn't be more black and white, right? So consumer confidence 6 years low, Nasdaq is going through the roof. At least the tech companies are profitable. They still have stock buybacks running, but I think everybody needs to agree that at this point, Apple and Tesla are so far away above the 250-day moving averages that it's actually it's frightening. To me, it's frightening at least. I mean, if Apple gains 3-4% a day, we basically gain another $1 trillion in like 10 trading days, which is just quite frankly insane. Tesla's price target today, by the way, got raised to $2,500 at Jefferies on the same arguments that everybody else has been using for the last couple of weeks. But again, I don't want to be the perma bear here. However, let's go step by step. So let's look at the big picture first. You prepared a couple of charts for us. What are we looking at here?
Well, this is a chart of the ES futures, and what you see here basically is the large trends, or I put some trend lines on it, major wedge, if you will. There's been a couple of different versions of this over the last couple of years, and you got to obviously adjust with the data point. What we have is a vertical V. Bulls are full in control. I will point out that if you look at the little blue line that's rising aggressively, that's the weekly 5 EMA. We are up 5 weeks in a row. And the last 4 weeks, we haven't even touched that 5 EMA, which is rare. So markets are extended for sure. There is a top trend line here that I can point to and say that could be a theoretical target here, especially if Jay Powell delivers even more good news for investors tomorrow. And going into Labor Day, perhaps, that brings you to maybe roughly 35.25. So let's say another 2.5% higher from here. My view would be that would be resistance. But also be perfectly honest, I had in April looked at the February gap on the ES as a technical resistance point. We didn't quite reach that in June, so that gave us a correction back into the below 3,000 zone. When we reached that February gap now here in the July-August timeframe, I thought there would be some sort of technical reaction. There hasn't been. Instead, what we're seeing now is a really tightening, smaller wedge pattern that's incredibly tight. And from my perspective, at some point that will break down, and then we're going to get some sort of reaction. Now, do we get to 3,525 first? I can't tell you that. It's certainly a part of the risk profile. My view would be in general that if we get another volatility spike, which I'm expecting, that we get another run at this 3,200 to 3,000 level. That'll be then the big control. Basically, look at the basic 50 EMA reconnect. You mentioned the vast expansion of or extensions of Apple and Tesla above the 200 MAs and so forth. All of these charts are incredibly stretched. So forget the macro discussion for a moment. Forget it all. Forget the price target raises. Just looking at this technically, when you have really extreme expansions above basic moving averages, you're playing with fire. Now, we saw in 2000 these things can get even more extreme, so I'm not denying that possibility here. But at the end of the day, we also got to look at monthly charts. If you look at the NASDAQ monthly, we're far outside the Bollinger Band. Usually that leads to a rejection as well. So I'd be surprised if we don't see a wobble here in September, October.
So Jerome Powell is speaking tomorrow. Der Chef der US-Notenbank hält morgen also eine Rede. And the Federal Reserve is indicating that they're not big fans of yield control, which basically means that they should, that the long end of the yields should be moving up a bit, at least if the economic numbers play along, and looking at the all the T-bills that are becoming due in the next couple of months. To me, it looks like the yield might be moving a bit higher. What's your take on that? And I would like to add a question from the community, a question that many people have been asking in the community, which is about gold. Looking at the possibility of rising yields on the long end, do you agree with that? And what's your take on the price for gold looking forward?
Well, let's start with yields. I mean, there's been nothing on yields in the last few months. The 10-year has been staying rock bottom. Now, it may be that if Jay Powell tomorrow outlines grandiose inflation goals, that may cause a sell-off in bonds and push yields higher. I don't know how long that would be sustainable. At this point, there is no indication that we have a sustained move in higher yields. By the way, you have a lot of debt. The 2018 rally ended when the 10-year hit 3.2%. That was the moment when, though, I think the financial construct realized the world cannot handle higher rates. So I think be careful what you wish for. If we get higher yields, it may be beneficial for the banks. So that would go a long way maybe to the reflation argument or the rotation argument into banks, okay? But the global construct is completely, entirely dependent on low rates to stay low. So if they want to bring about inflation, good luck, because debt has to be refinanced at higher rates, and there's a lot of debt coming that has to be refinanced. On gold, we've been, if you look at the site, we've been bullish gold for a long time. Actually, since last year, we had multiple bullish patterns, and that's kind of general point I'd like to make. Gold has been sending a signal since 2019, way before COVID. It had one bullish pattern after another. Yields have been sending a signal way before COVID. When we had the rally into December, January, the yields were not confirming the rally, and they're not again at this very moment. So in terms of the structural backdrop, gold has been very bullish. It now hit our target. So I would say if we get a retrace here into the 1800, 1900 area, and it bases there for a while. Remember, we just had another.
So, jetzt ist die Skype connection is quite bad right now.
Vertical.
Okay, you froze a couple of times because the Skype connection is doesn't seem to be that strong. But just to repeat what you said, so basically, if I'm not mistaken, the 50-day average in gold is at about 1850. So retracement to that level seems possible in your opinion, yes?
Oh, absolutely, absolutely. Yeah.
Now, one thing I would like to touch with gold is, this whole debate is, does gold work as a hedge instrument? And it's been quite interesting to me that the correlation between gold and the Nasdaq and gold and Apple seems to be relatively high at the moment. Gold also sold off in the March COVID-19 crisis. So should the market actually start correcting, wouldn't that also result into gold correcting?
It really depends on positioning, right? I mean, if you get liquidations like you saw in March, everything gets sold. Yeah, Bitcoin was supposed to be a great hedge. It completely tanked in March as well, right? I mean, I personally, I'm careful with any correlations that have meaning at the moment. In fact, I think most correlations are kind of busted at the moment, because keep in mind, what we're seeing right now is extremely distorted. Okay, so be careful. You know, and there's a lot of chasing going on. Okay, because people are chasing narratives. They're trying to rationalize the action that we're currently seeing, and that's always tempting, right? And in any bubble, you want to rationalize the price action with fundamentals. Be clear, none of this has to do with fundamentals at the moment.
I mean, it's like, I mean, to me, it's really fascinating, because I do think, I mean, I agree with you on the correlation level, but, you know, it feels to me like many are basically doing the same trade and not realizing that, you know, basically, you know, many people are, I know that shifted lately in the last couple of days, but you had a huge long position on euro, you had a huge long position on gold, you know, everybody and their neighbors thinking real rates are going to stay negative. And technology is going through the roof. And I think by the end of the day, to me, it feels like it's all the same trade. I mean, if real rates turn out to be less negative, that will support the dollar. If the dollar gets supported, that will undermine the gold price. That might undermine technology stocks. What's your take on that?
Well, look, again, it's about positioning. And I think we have a lot of extreme positioning going on. And my concern is, in general, people are not very much diversified, or not even as diversified as they think they are. You know, coming back to our earlier discussion about why the indices are going up vis-a-vis the market, right? If you're buying or selling the S&P, you're intrinsically dealing with 5 stocks controlling 25% of that index. If you're in the QQQs, you got 10 stocks that are at 56, 57%. So, you know, everybody, and that actually is just a general point, and why funds are lagging the indices or the benchmarks, because they are generally diversified. If you're diversified in this market, you're lagging, and that's probably one of the sins that I blame the Fed for. They've created an environment that forces you to be, on some level, reckless. It's the Tina effect. There is no alternative, so we have to chase asset prices through the roof. That's what's going on right now. And because people are so desperate for yields, and they're desperate for winning narratives, I think they're ending up exposing themselves. Now, none of this matters. None of what I say has any meaning until after the fact, right? Until something breaks. And so far, nothing is broken. So that, you know, it's kind of a pointless discussion in that sense. You know, but as I'll just keep saying this, in the recent years, the moves have gotten more extremes, and the turns have come very fast. Remember January 2018, quick snap 10%. Just September 2018, quick snap 20%, right? You have these quick, and then of course 35% now in February. And then the other piece I would add is, you know, as much as hopeful as we all want to be about this COVID situation, I think we got to be all very open-minded, or just at least recognize that we don't know what this virus is going to do. Okay.
You know, I got this question from the audience that I hear a lot, and even a lot of institutional investors are saying this. So, you know, bubble, you know, whatever bubble, yes or no bubble, but the reality is there's a lot of money, and the money has to go somewhere. So in other words, it's going to the stock market, and that for me goes into this whole argument, you know, there is no alternative, and you know, and then the fear of missing out in the market. And I think there's also, you know, obviously, you know, there's a certain truth to that, you know, especially with bond yields almost at 0%. What alternatives are out there at the moment other than the stock market?
Well, that's exactly it, and that's why we're getting this valuation exacerbation. I keep making this point about market cap to GDP. We're actually now at 180, 182% market cap to GDP. And I expect that actually to come down as Q3 GDP is going to bounce up sizably. So we have to recognize that the Q2 number was a bad one. But if you just annualize it across the whole spectrum, we're still above 160%. And just to be clear, folks. The top in 2000, the Nasdaq bubble got us to 150% market cap to GDP. The general view, this was all before the permanent central bank intervention. Market cap to GDP used to run around 65%, 85%. In 2000, when we crashed, we got down to 50%. In 2007, when we crashed, we got to 75%. We are still in a global recession. We have the highest market valuations ever. And yes, if you want to play long, go ahead. I mean, I'm not telling anyone not to play long. You just got to have an exit strategy. And
that's a good point.
I can tell you, I don't think people got out in February. Okay, it happens so fast. Okay.
Yeah, you have to have an exit strategy. I couldn't agree more. Let me go to one question from Niels. So do you think that there is a possibility, and in which environment would that possibility come true, that the Federal Reserve would end up buying the stock market directly, like the Japanese buy the ETF market?
Oh, very simple. I think if we drop back to the lows, you actually look at, legally they can't do it right now. But Janet Yellen, over the last few years, has laid the groundwork. She's gone in front of Congress. She said it directly. It would be helpful for the Fed to be able to buy stocks directly. She actually said that. So trust me, if they think they lose control, and we see a massive reversion of all this, by the way, which I'm probably the only voice out there that still thinks that.
Yeah.
And maybe it's because I'm wrong. That's possible. But if I look at the overall market structure, look at the macro environment, we could still be in a bear market rally. In fact, if you take the 7, 8 stocks out of the equation and just look at the broader equal weight market, the market actually is reacting not that much different than it has before. Keep in mind, and this is just a general technical comment, over the last 20, 30 years, the big bottoms come on retests. They come either on a higher low or a new low on a positive divergence. Every single time. It happened in 2003, it happened in 2008, 9. Even in 2015, you had these retests, right? 2015, 2016. It was only in 2018 on that V-shaped Powell flip-flop that we had a V. And it's been here in 2020 on this obviously insane central bank intervention, these V shapes that never retest, that never basically reconnect with the economy. So my general macro point is, because central bank intervention has morphed into a state of permanency, markets never really get to correct, right? And all of us, every single one of us, has now gotten used to this pattern where nothing matters after a few weeks. And so markets are disconnecting ever further from the actual fundamental size of the economy. To me, that's the ultimate danger here, because first of all, we're all being trained that recessions don't matter, that nothing matters, and ultimately central banks just basically run the financial markets. But there's this old concept. I think it's a scientific theory. It's called gravity. We should look it up.
Yeah, I agree with you.
At some point, gravity matters.
But I couldn't agree with you more. But if I look at the environment, and I'm trying to look at what's coming up. We have the Fed speech coming up. Let's say Morgan Stanley is right. We see a growth slowdown temporarily. Well, but I can argue anything right now and turn it bullish, right? Because if we get a growth scare, which should be negative for stocks, the result will be an even bigger fiscal package coming in September, because we have the election coming up in November. So Donald Trump indicated that he wants to push through, if he can or not, we'll see, the magical medication against COVID-19. So again, we would have a reason to push the market even higher. So, and considering the fact that the market has been ignoring pretty much any bad news, because there aren't any bad news. If you got bad economic news, well, we print more money. If we got bad news, we do bigger fiscal package. And we see, linearity, well, July is already better than June, and June was better than May, and, the subways in New York are fuller again. So it seems like we're so focused on good news right now, and with the election running in, and the fact that elections very much also get decided about how the stock market performs leading into the election. It seems that Donald Trump and the administration, they have a lot of interest in pretty much keeping the market up for quite a while.
You just made the bear case for me, actually. No one sees any downside. In fact, if you look at the data, asset manager index is max over 100. Everybody's fully long position. Short interest on the S&P is at 15-year lows. Bears are capitulating right and left. No one can think of anything that could go wrong. Well, perfect. That's kind of your classic setup. Now, as I said, there's upside risk, and no one will ring the bell at the top. Okay, my technical view is that we are stretching these charts to a point where a reversion can come out of the blue at any time, and then it's going to happen probably fairly aggressively, and you're either in the move or you're not. It's unfortunately, tops are really hard, especially in this environment, for sure. And let me just add a political point, although I'm not a political person, but I'm watching the narratives very closely. And I think this is something everybody has to keep a close eye on. This election is going to be very different than any other previous presidential election because of the environment that we're in. Donald Trump has said it very clearly on numerous occasions right now. If he loses, the election is rigged, as he calls it. That means he will not accept the results. Hillary Clinton yesterday told Joe Biden not to accept the election results if it's close, right? Because everybody is now concerned, and this is unfortunately what's happening in the United States. There's such deep structural mistrust for either side, and people are being so divided that I'm worried about that the U.S. actually is going through a process where neither side will accept the election. Of course, the winner will accept the election. Yeah, I won, right? But the loser will not, whoever that may be. And then this drags out in the courts. Now, in 2000, when this happened with Florida and Al Gore, that was a different situation because Al Gore actually then decided at some point, okay, he's not going to push this and call it for the good of the country, if you will. Not this crew here. There's no way Donald Trump is not going to push this to the nth degree. And so my concern is, everybody thinks kind of hunky-dory. Political things can happen. I'm not predicting this. I'm just saying I see kind of the narratives building where something like this could possibly happen. And if you do not have a clarity after November 4th and this drags through the courts for months, I think you may be looking at a very, very uncertain situation into year end. That could also be consumer confidence dampening. Just saying.
So I don't know if you're willing to make a statement, but who do you think is going to win?
Yeah, I have no clue. I would. It's amazing. I mean, Donald Trump's support has remained incredibly steady. I'm not going to make a judgment call one way or the other. I think what's clear to me, though, is that he knows that I think he knows in general the polls are against him, right? I mean, the U.S. election has now been decided twice, not by the majority of the popular vote, but the Electoral College. So it always comes down to the swing states. And what I see in terms of the narrative, this is my opinion, you're free to disagree, but I think his odds are better if fear and voter suppressions work, keep people from the votes, if he can make it as difficult as possible. The Democrats, on the other hand, I have to also say, as long as market levels stay high, I think that will keep the appearance positive. Doesn't matter that there's still 9, 10, 11% unemployment or higher. So it's a tough call. And then, of course, what we can't predict is what's going to happen in the next 2 months in terms of news events. I think there's still a lot floating out there that is completely unpredictable. And then, of course, there's debates. You know, debates can matter.
This reminds me a lot about the re-election of George Bush Jr., where his ratings were quite as bad as Trump's ratings are right now. He activated his voter base and he got re-elected. And I personally think if the stock market manages to hold the current gains into the election, which will be interesting because September is seasonally a weak month, and the last 4 elections, the 6 weeks leading into the election were weak on the market. But if this doesn't repeat, I think there's, in my opinion, it's very likely that Donald Trump will be re-elected. But of course, nobody knows. We'll find out after the election. I would like to do the last question because I really appreciate you taking that much time after starting without audio. One question from the audience and a chart that I've been using the last couple of weeks. I don't have it here, but you very well know what the chart looks like. If you look at M2 money growth, which has been vertical, and I know that we both follow Nordea quite well, which has great research. That would be an indicator that the market goes higher, no? If you look at the vertical development of money growth and the fact that it's a leading indicator, no?
Absolutely. I mean, M1 money supply as well as M2, it's completely vertical. I mean, in fact, it's gone. That's been kind of the companion since 2009. I mean, they really went into overdrive back then. It was actually kind of steady in the 20 years before then. But then it's been growing and growing and growing. What's not happening is velocity, obviously. We don't see that money actually going into the economy. And so therefore, I remain very much open-minded to the fact that what we're seeing here is an incredible sugar high that will have to, basically what I'm saying is the economy has to prove the expectations that have been set by the equity market, okay? There's nothing but optimism. There's nothing but long. There's, as you said earlier, everybody's capitulating. No one thinks markets can go down. I think that narrative will get challenged at one point this year.
And
then we'll see. Then we'll see. I mean, for example, if there's absolutely no question about who wins the election, I think we may get this massive relief rally one way or the other, and then they jam it into year end. I can certainly see that. From a technical perspective, I'd like to see opportunities to go long from a bit lower than here. Let's put it that way.
And while we end our live stream, the S&P is now up 150 points one more time, 1.3%. Gold is up. The Dow is pretty much unchanged. So the narrative seems to be the same. Technology rules the world, and there is no limit to market cap expansion of the big technology companies. NVIDIA, Salesforce today up a whooping 27%, which is absolutely insane. They were fantastic numbers. Don't get me wrong, fantastic numbers. But is it worth 30% of the entire company repricing overnight? I don't know. But in any case, good luck to everybody that owns the stock and to everybody that is invested in technology. Enjoy the run. And it was interesting to me that I think your take indeed is that the market could run higher before we get a setback. I'll say thank you to you. Somebody in the community said it's actually not Sven Henrich, it's actually Henrich Sven. Which one is the correct way to addressing you?
Sven Henrich.
Sven Henrich. So I got it right. Okay, that's great. I would have been very surprised because in your Twitter account, it's written like that as well. So I say thank you very much. I can only recommend everybody in the community to check out your Twitter feed. Fantastic. And of course, your newsletter, your daily newsletter as well. And I say thank you very much. Thanks for taking the time. And I'll talk to you very soon in the future. And best of luck to you. Have a good one.
Thanks, Marcus. Have a good one. Tschüss.
Ciao.